Gagan, and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go. Release your underwriters to underwrite with Advantage Go's underwriting platform. Today's interviewee is making his fourth appearance on the podcast, which I think makes him my most interviewed guest. But as he is the CEO of Hannover Re, one of the world's largest and most consistently outperforming reinsurers, I'd love to be able to have Jean-Jacques Henchoz on the show even more regularly. Very few underwriters have such a global view of the market, and the timing is impeccable. A week before the festival of reinsurance that is the Monte Carlo Rendez-Vous is the perfect time to catch up with someone like Jean-Jacques. This time we have an encyclopaedic conversation that somehow manages to encompass the state of the treaty and facultative reinsurance market, life reinsurance, AI, carbon capture and climate change, as well as lessons learned from the recent Baltimore Bridge and CrowdStrike loss events. Jean-Jacques is always unassuming, but disarming in his directness. In many ways, he is the epitome of the adage that in life one should speak softly, but carry a big stick. Happily, with the market in such a strong position, it looks like the stick won't be needed. And I find Jean-Jacques in excellent spirits and looking to continue growth and deepen further his partnership with clients. With the reinsurance market at a far more nuanced stage than it has been for the last couple of years, there's a lot of insight packed into the next 40 minutes. And I can highly recommend a listen. Enjoy the podcast. Jean-Jacques, welcome back to the Voice of Insurance. It's always really good to talk to you. It's the middle of the summer. We're getting ready for Monte Carlo, and it's time when we start talking about the reinsurance market. I don't want to put words in your mouth, but I might as well start by saying my long career of looking at this market and being part of this market, it seems like it's in probably one of the happiest places it's been for a long time, or at least a relatively happy equilibrium, because we've had our clients, so the cedents, have accepted new pricing and new structures. There's enough supply to meet their demand, which perhaps, let's say, a year ago or 2 years ago, there wasn't necessarily. But also at the same time, there hasn't been a huge influx of new capital. Most of that new capital appears to have been retained profits, that kind of thing, or capital that's been rationed to only, let's say, the top tier players. Am I being accurate in my assessment?
Yeah, no, Mark, thank you very much again for inviting me. And all you said is a fair statement. We're in a better place in the reinsurance market. We had some tough years as a whole industry in the soft market for a few years. And investors started to have some fatigue with the industry and simply saying, you're not earning your cost of capital. This just doesn't work anymore. And that investors' pressure has led, together with other drivers, to a situation of reset, basically 22, 23, and has pushed the industry to show discipline, to show rigor, consistency, and rate adequacy. And we are in a much better place. And I think the notion of equilibrium is a fair one. You never know where the market is going the following year. But we're at a place where, as a company, we feel that most of the business we renew, put in our books, is fairly priced and gives us confidence for the next 1 or 2 years. As many incumbents, we have a very strong balance sheet now. We are able to increase capacity. That means that the increasing demand we're seeing globally can be covered. So we have an equilibrium at the moment. There'll be some rivalry, as always. It needs to be competitive, but it feels like we're in the right place. But we needed this reset back in 22, 23. It was just not sustainable for the whole industry, even if Hannover Re was an outperformer. But as an industry, it didn't work.
And I suppose with those good numbers, does that give you a little bit more confidence? We've had some good numbers. Do you think that's giving investors a little bit more confidence in us, or have they still got painful memories from previous years?
In my view, it will need a couple of years at least for many investors to regain true confidence. They are looking at the industry. They see promising signs of underwriting discipline and good rate adequacies. Some are investing in incumbents, companies. Some are going for ILS structures. But of course, until we come to a situation where we'll see a new class of reinsurers, you alluded to it, it'll take more. I'm not even sure this will happen in the next 2 to 3 years, to be frank, because the incumbents can cover the needs of the market, and an entry point at this stage of the cycle is not exactly easy. So don't expect in 25, 26 a lot of fresh new capital in the form of new entrants in reinsurance.
So within this equilibrium, I suppose it's a moment where buyers can get more of what they need, not necessarily all of what they want. I suppose if you asked the average buyer, someone who had to reset their buying completely nearly 3 years ago, previously they would have had lots of protections that would be able to protect their income. And obviously they've gone back to the traditional role of reinsurance to protect their capital, which is always there. Do you think within this better equilibrium that we've got now, do you think any of those buyers coming into the market looking to buy some of the sorts of things that they used to buy 3 years ago quite easily and that they'd been buying for that preceding decade, lower attachment point type products or aggregate type products, things that are going to protect their earnings and smooth their earnings more, do you think they might be a little bit better received than they would have been maybe 2 years ago? It would have been, hang on a minute, no way, we can't talk about this stuff anymore. We're completely resetting. We're going back to the traditional role of a reinsurer. Do you think now they might have a better hearing or a better chance of getting what they want?
I cannot speak for the market, of course, Mark, but it's clear that the discussion is taking place. When it comes to Hannover Re, we feel that a large part of that necessary reset was the change in attachment points that creates a bit more skin in the game and a more balanced sharing of the enormous risk exposures we're taking on our books. So we're not open for business when it comes to challenging that necessary reset at this stage of the market. This being said, of course, there are many different clients' motivations, and in some instances, that element of smoothing over time could be the driver for an open discussion with respect to structured solutions. So we're willing to look at it with our structured team. On a purely traditional basis, we're still reluctant to shift back to the old world, so to say. But it might be that these discussions are taking place now ahead of Monte Carlo and in Monte Carlo, of course.
It sounds like there's sort of solutions that end up being quite expensive, and there are certain ways of justifying them economically, but it has to be something that you feel that you need.
Yeah, I think, if the motivation is related to the price of the coverage, of course, this will not work. If this is really to manage the portfolio over time with a multi-year view, I think that's a good discussion, which we should always have independent from the market cycle we're in. We're open, the door is open, we have these discussions. I think it all depends on the driver, the motivation from the ceding company.
I remember we were talking a year ago, something that had changed in your portfolio makeup was a move towards more non-proportional business as opposed to proportional. Has that trend continued for you in the last year?
It hasn't changed completely. Here we saw the emerging pricing trend in the primary business, and that was a sign that the proportional portfolio was a bit under stress, and in some instances we could not make it work and had to reduce some of our shares, and we've grown quite significantly in the non-proportional markets. This was more tactical than a strategy. It was a response, again, to the primary cycle. And when the moment is right, we're more than happy to grow again in the proportional business. But I think at this stage of the market development, this is here to stay. So 24 is impacted by the decision. You see the top line, which seems to be growing less than it used to be. But in terms of bottom line, we've been growing quite significantly. But it's all this shift to non-proportional covers. It has worked for us. We're agnostic. It's just a way of looking at the economics and then taking a tactical decision, renewal after renewal.
So you just see if there's a better way of doing it for Hannover Re, then you'll do it that way.
Yeah, we're not ideological about it. It's just a matter of price dynamics. I think the primary commercial pricing is under pressure again. So I don't see 2025 being a shift back. But who knows, at some stage, we might be able to support some of our clients with proportional capacity.
Sorry to interrupt in mid-flow, but this is just a reminder that you could be advertising right here, right now, and getting your message directly into the ear of key decision makers in the insurance industry. And you'll be doing it while they're absolutely in listening mode. The podcast is the medium of the future, and so is audio advertising. contact me on mark@thevoiceofinsurance.com and I'll do everything I can to get you started. I know it's kind of dull talking about cyclicality of the market, and even after 30 years, it's still almost eternally fascinating.
Mhm.
But do you think this is an illustration of where we are in the market cycle? And is it a sign that we're near the peak or just past the peak, would you say, given that obviously at the beginning of a hard market cycle, proportional business is probably the easiest way of riding that improvement in terms and conditions and getting more income straight away. And now all those price rises have been passed through to those original clients. And now if we're seeing, you're saying, increased competition on the primary side, would that indicate a peak in the cycle for everybody?
I think it's fair that based on the facts and figures, we're at the point where there's a balance. We're happy on the reinsurance side to see that kind of price adequacy. This being said, there are a number of trends which we monitor very carefully. Climate change is a prime example of that. You've seen the number of so-called secondary perils being in the headlines in the past few years, whether we talk about floods or wildfires or flash storms and things like that. You have a real issue of frequency and sometimes severity. So it's not like everything would be stable and everything is great. I think we are still in a period of time where there is a genuine issue of affordability of insurance and sometimes availability of insurance. And it's important for us as a reinsurance player that we work with our clients to make risks insurable. So we have that joint challenge. So, I don't feel happy at all if I'm successful as a reinsurer and I see my clients struggling. I'm not really very pleased to see the protection gap increasing year after year. 2/3 of natural catastrophes are not insured. So we have a problem of underinsurance, and the challenges of affordability and availability need to be taken seriously. So yes, I'm happy when I look at quarter by quarter the performance of the company, sure, but it's also important for us to recognize that we need to stay relevant. And if we cover 1/3 of the large risks in this planet, then we're probably not entirely doing our job as an industry. And that's the big challenge, which we need to tackle together with our clients, frankly speaking.
Yeah, I mean, there's no point doing really, really well in a market that is shrinking.
Exactly.
And that eventually we will just end up insuring the single risk that's been left insurable in the
Absolutely.
world.
We don't want to shrink to greatness, as we say. And therefore, we need to work on making risks insurable through innovation in particular, but also through good dialogue with the public authorities on prevention, on infrastructure upgrades. That's a discussion we've had in previous podcasts. This is also our role, and this is something we want to do together with the insurance industry.
Actually, on that innovation, something that struck me that I found interesting in the last year, I'd done some interviews with the people behind some of the carbon credit insurance. Seems very, very interesting. Some people were describing it to me as potentially the next cyber, a really interesting and relevant product that's going to be relevant, particularly over the next 30 years of transition. Do you see it the same way? Are you excited about it?
It's really an area with enormous potential. Clearly, we're seeing that transition to a decarbonized world happening. It takes a bit of time for that market of carbon offset to really develop, and we are at an early stage. We have discussions with some of the stakeholders in that emerging market. And I think midterm, we're going to see some reinsurance opportunities. At this stage, this is not the case. So it's really an emerging opportunity. But we're pleased to contribute because that transition is happening and insurance must play a role in that. And what I like is that when we're speaking figures, we're entering into a phase where we're trying to form business cases, and we acknowledge that we can do good and do well at the same time. That it's not an issue to make money while contributing to the transition in the real economy. So this is a very good development. We follow carefully. Short term, it will not be a headline at our Investors Day.
No.
But mid to long term, it could play a role, yeah.
Yeah, because it's the sort of thing that at the moment they won't not want to need a really big reinsurer's full capacity, but it's something you can keep your eye on. But it would appear that if it develops in the way that it might, that, yes, in 10 or 15 years or 20 years, we might be talking about, wow, this is a big line for all of us.
Absolutely. So it's smart to be in the game already now and maybe test and learn at a small format just to understand how it could work in the future. So we're willing to do a couple of pilots if we have good opportunities coming in.
The risk itself is not a simple risk, and it's a combination of so many interesting risks. But yes, a traditional fire type risk or a political risk and or execution risk. There's a certain amount, an element of commercial kind of enterprise type risk, which I know we don't want to have anything to do with it. But at the same time, what I liked about it was that it's the moment where insurance does good things. It helps to multiply positive effects in the economy and make other people's capital go further, or the investors' capital, the bank's capital. It goes further because when you add the insurance, then they can lend more or they could do more investments, that kind of thing. And of course, in itself, it is a positive thing, which is going to improve the risk environment for insurers, which has got to be a good thing.
Absolutely. And it's going to foster entrepreneurship and innovation in the real economy, technology changes, energy transition. So there are a lot of highly interesting topics which, as insurers, reinsurers, we can encourage. So it's good to look at it. This being said, we are active in terms of promoting, fostering that transition. We're seeing ESG type of projects, both as a reinsurer, but also as an asset manager. So I think there's a lot we can do beyond that. But this potential of a carbon credit market emerging, developing internationally is very interesting. And it's just a matter of time until it's going to be in place. We'll see how much time it will be, but it will happen. I'm quite sure it will happen.
And of course, as an investor these days, your balance sheet is so large. It's not insignificant. You can make a difference by deciding to put your portfolio, to move it around according to ethical, social, and governance considerations.
Exactly. The only caveat I would put is, of course, that we're bound to asset liability considerations. So we need to have a proper matching. So this limits a little bit our margin of maneuver. But I would love to see regulators thinking about capital requirements in the context of encouraging that transition. This is a debate which is not really happening as we speak, but creating some incentives to make some of these long-term investments or investments which are a bit more risky, more affordable as an investor. So there's so much we can do. There might be flexibility to do more, but asset and liability matching remains the name of the game. We cannot compromise on it. We're not allowed to do so in the first place.
Well, yes, and it's just not prudent, is it? Because we all know what happens. If you get it wrong, then you won't be there anymore.
Exactly.
Well, you mentioned before about technology. I'm taking all of these things a little bit out of the order that I am expecting to ask you questions in, so I hope you don't mind. But
not at all.
You mentioned about technology, probably in the last year, that no one could escape artificial intelligence being everywhere on every headline. Certainly 8-9 months ago was probably the peak amount of sort of media hype about artificial intelligence, and certainly every CEO around the world was going to be asked by their investors, what are you doing about this? How are you thinking of applying it? Or where have you seen interesting use cases? So where are you seeing, as a reinsurer, in the insurance and reinsurance value chain, where do you think the best applications are at the moment, either in some of your clients or yourselves?
So with our clients, we're following very carefully what they are doing at this stage. We see a lot of use cases around the client's journey, simplifying the way insurance is purchased, how claims are being processed. So there is a lot of potential use cases in the primary space. And for us, it's important to really understand what it means in practice when it comes to the risk profile of the portfolios we underwrite. And so understanding these use cases in the primary sector is an important task for us, because indirectly we'll see potentially the benefit of it, or some risk of anti-selection in some cases if our clients are better informed about the risk profiles. So that's important to look at it. Then for us, as you know, we don't have millions of clients. So there is so much you can do in terms of efficiency improvements. But nevertheless, we feel that the technology could help us becoming more efficient in our back office activities. And we have a number of use cases already, which allow us to process a growing number of treaties, businesses without having to increase headcounts as much as we would had we not the benefit of the technology. So there is a scalability potential in terms of automation of processes. But down the road, I hope that AI will allow us to do even better underwriting, to relieve the underwriting community from some non-adding tasks, to focus on really analyzing the data, analyzing the risks. Of course, on the modeling front, there'll be some improvements as well. So I think, I heard that expression that AI is overhyped and underappreciated. I think there is a bit of a hype. We should not have this fear of missing out every day. On the other hand, it's clear that it's going to transform many, many sectors, and therefore the risk profile of many industries. The risk of fraud is going to increase significantly. You could use my voice based on a half-a-minute clip and then have a video with my voice in any language now and ask $1 million from an employee at Hannover Re. This happens on email today. It might happen on video in the future. So we need to be very careful about the dangers of AI, and therefore regulation and some standards of ethics will be very important as well.
So at the moment, do you think your balance is more about that productivity, about easing processing, log jams and bottlenecks and the usual things, more than on the skill of the underwriter? Is it more about making that underwriter more productive at the moment, do you think?
Yes. Indeed, I think that's where we see the most use cases which we can scale up. But over time, I think we will focus on use cases which would, in a way, give augmented capabilities to the underwriter to better understand the risks, having ready-made information on a portfolio of risks worldwide without having to look for it, and standardizing the type of information you get. So better insights, better data granularity, and immediate ability to judge a risk, to price a risk. So an efficiency play, but also an augmented underwriting play, which is coming soon, but not yet front and center today.
So more like artificial intelligence assistant that's triaging some of your workflow, saying, well, you should look at this first because we know you're going to love this one and you could be competitive on it and you're going to get a firm order, or you're more likely to get a firm order if you answer this one quickly, those sort of things.
I think so. And, one other big potential I see in primary and in reinsurance is to prioritize the risks which have a better chance to be profitable or to be within our risk appetite. So particularly in the single risk business, you have a lot of incoming inquiries, and being able to prioritize and select those with the most promising closing chances is attractive. So I see some applications there as well. Part is efficiency, but part is also using our resources in an optimal way.
And that's going to keep the brokers happy, obviously, as well, because it knows that you'll be really quick on the ones you really want. And I suppose, and all your competitors will also be. And of course, you'll have slightly different appetites. And so there'll be less time churning around the market looking for the person who has the appetite in this territory, in this kind of occupancy at this particular time.
Absolutely. Yeah. That'll be much easier for intermediaries to place the risks and to be more efficient. Absolutely.
So into that market, into the facultative market, anytime you have a market hardening, you have a bit of a boom in facultative because as treaties get more restrictive. How's it going? Is that boom set to continue, do you think?
At this stage, I think it's continuing. Of course, there was a bit of a reaction to the reset on the treaty side, so more need to create more volatility management through single risk sessions. So the facultative side of our house is very, very strong. It has been growing steadily. It's very diversified worldwide, risk classes, and it has been very profitable. So we're keen to grow, but we remain disciplined. The two things we don't want to compromise on, and that's valid for treaty, but also for fac, is the diversification of the book. And the other one is really rate adequacy. So if we are in a market cycle where we can take up risks which are within our appetite and price requirements, we're very, very keen to grow in fac. My sense from the many discussions I'm having with customers and with brokers is that we're going to see some growth in 2025, possibly 2026. But I see facultative as one of our growth engine in P&C.
I suppose it is the ultimate spot market for reinsurance, isn't it? It is what is
Absolutely.
happening today. And of course, the wind can change.
It can change rapidly, indeed. But it's also, I mean, it's important for a reinsurer to be close to the action. And facultative is the toolkit for that. You're very close to the original risk. And that's also through the facultative underwriting that you know where the cycle is going. So it's important to be strong in FAC. And we have a very good team. But we are determined if market trends are changing to shift. The strength of a reinsurer is the capital allocation. It's all about capital allocation, be able to retrieve, to reallocate towards the most promising, most profitable segment. So that agility of capital usage is the name of the game. That's how you get the extra profitability, and that's something we take extra care at Hannover Re.
Well, when you're having your debates at the top table about where we should be allocating our capital today, obviously a big part of the whole world has been this casualty debate, both in insurance, in reinsurance, in every territory in the world. And obviously we've had our inflation. It has turned out to be a spike rather than a permanent upshift in inflation. Inflation has come back down to more reasonable sort of central bank guidance type levels. So what's your current thinking? Is this market more attractive than it was, so at least for new business coming in, than it was a year ago?
It is slightly more attractive. I think interest rates played a role in there. But we still have, as an industry, to struggle with prior years, which are developing rapidly. Some years have elevated activities. So we have to look at the in-force. It is in many cases not enough to compensate for the incredible movement towards social inflation. The litigation industry is extremely powerful, as you know, and the litigation risks are enormous, and they are increasing. This is clear. So my sense is that we absolutely need to tighten the terms and increase prices to be able to grow in that segment. If not, we'll keep managing our portfolio, grow incrementally with our partners. But I don't see any sort of bonanza in US casualty, even in this favorable market environment.
Yeah.
It's a tough industry to be in. And unfortunately, the money flowing into the litigation finance industry is extremely material and growing. And that's a big threat to the insurance industry.
At least I suppose having effectively real interest rates for the first time in a long time, since almost been 20 years, hasn't it, since we could actually make risk-free returns.
Exactly.
Presumably that does at least make long-tail business more attractive if it's written today.
Absolutely. No, that's clear. I mean, there are more opportunities than we had 2-3 years ago, but more is needed would remain my message to the market participants.
Okay, well, continuing our sort of roundup of interesting classes in the market and interesting trends, we've seen life and health business make some negative headlines around the market in this sort of H1 results season. Is there anything we should read into this? Anything structural we should be reading into this? Is something about the economic cycle or anything that we should take away from it that would cause concern?
This is, of course, the big question which was raised the last couple of weeks from the investors community, and we handled that. I don't see any systemic topic being raised all of a sudden. We're talking about in-force business, not new business. So it's how to manage the in-force on the life and health business. And clearly, US mortality has been underpriced in retrospect. We recognize that, and many large reinsurance companies had to deal with in-force challenges, and Hannover Re is included in that group. We had a decade of correction to the in-force mortality business in the US in the form of tightening terms, in the form of repricing when we could. And as far as our company is concerned, we're happy of where we landed. We had a lot of work behind many management actions. We even had arbitrations with our clients in the US. So it was quite a painful process, to be frank. But we're now at a point in time where we're happy with the book of business, and we have steady flow of attractive business coming in, mainly when it comes to the US in the form of financial solutions or more structured business than pure traditional US mortality business. But we're happy with where we are. So it's more of a look back at in-force portfolios, and sometimes you get a bit unlucky and you have a number of bad news in one quarter. But this is not by any means a trend which is relevant for the whole industry. It's a timing issue. we managed over time to balance out the good guys and the bad guys, as we say, in steering our portfolio. And we're happy of where we are. The life and health business at Hannover Re is very profitable now and is a good contributor to our earnings. So we're very happy. It's a bit 1/3, 2/3 life and health, P&C. And this is a good balance. There's diversification between the two. So we're very happy to have strong life and health franchise.
We're always learning something new, I suppose, in this industry. Events are always teaching us something new.
Yeah.
And in cyber, obviously, which is a new class in itself, relatively new compared to everything else, we've had some new information, new ways that we've now learned that there are other ways of making losses that are not malicious, that we've had a more error and omission type loss with the CrowdStrike event that we had recently. Has it made you think differently about being a reinsurer of that class, or was that actually a business as usual type loss that was already in the equation, was already in your playbook, thinking, well, of course, it has to be there?
No, I think it was an awareness event for sure. It will not be as costly to the industry as we might have feared in the early days when it happened. But we had our awareness raised for sure about the interconnectedness of our world and the fact that software issues can lead within a few hours to a big global event. So it certainly gives us some good insights on scenario planning, on portfolio steering, but it doesn't change fundamentally our stance that we need to create that market. There is a need, and we want to respond to that need. We need to tackle the accumulation scenarios, and we're trying to tap into the capital markets to diversify a bit the sources of capital and limit our exposure. So if anything, we're probably even more cautious than we were. But to jump to conclusion and say, cyber should not be insured at all, that would be too much for an event which was massive, but not that costly after all. So it limits the growth potential of the cyber market for sure, because this caution is in the market. But we need to work on these problems and understand how to structure cyber coverage in the future. So we will see growth in cyber, and having cyber events, hopefully manageable cyber events, are the way to learn and to improve. Like NatCat 40 years ago, we were still learning a lot about how to model a NatCat risk. So it's a bit the same learning curve. So I remain optimistic that we find a way to make cyber insurable in the future.
And certainly it can't do any harm for demand in tech E&O. And of course,
Absolutely.
We will have highlighted to any insured whether they had the contingent style business interruption coverage or not.
Exactly.
Because they would have made it really clear to them what they should have bought rather than what they ended up buying.
And I think, one positive is that cyber security standards are going to increase further. Regulators are looking into this, are very stringent. This adds to the cost of doing business, but it makes risk exposures more manageable. So the more stringent standards in cybersecurity are a good thing for the further development of the cyber market. And there's a lot of innovation which can be developed. We had a small attempt to have a bond in the market, a cyber cat bond. Cumulus Re, you might have heard about it.
Yes.
Was a good proof of concept and hopefully a milestone to create capacity in the capital markets as well. Lots of good development there.
Well, in our roundup, we go from one of the newest class of business to one of the oldest. We'd have to debate between a fire underwriter and a marine underwriter as to which is the oldest class. I don't think we'll ever know. We'll have to ask insurance historians. But since we last spoke, obviously, we had the Baltimore Bridge loss. How do you assess it? Is it something market changing for marine casualty?
It's a bit early to say. Of course, the magnitude of the insured loss is still being discussed.
And I suppose it all depends just on how long it takes to fix a bridge, for example.
Absolutely, yeah. I think that's one, but the other one is how much of an impact it has on the coverage. And certainly it raises the awareness of the industry on accumulation scenarios. And clearly also, it might sound a bit self-serving, but on the need for reinsurance to cover these unexpected, very large exposures. So we'll see how it plays out. But it's a very complex claim needing quite a lot of iterations. It'll take a bit of time until we're there, but the specialty underwriters are sharpening their view on such large risk exposures. and try to manage their capacities better. And of course, like always, risk adequate pricing is the name of the game in this line of business as well.
Yes, certainly when you look at the reinsurance, say that large marine casualty reinsurance that is in place, you think, well, yeah, the exposure is pretty much every ship in the world, anywhere. And then reading in the media after this bridge strike, it was only afterwards that you realized that actually they were surprisingly more common than you would have assumed. It's just a lot of them didn't have the same consequences, of course.
Exactly.
But yes, it's a bit of an eye-opener, certainly from
Absolutely.
my perspective.
Yeah. Yes, I agree.
One thing that's really changing, and it's been changing perhaps in the last 3 or 4 or 5 years, has been the growth in MGAs and hybrid carriers, and the hybrid carriers that are often set up specifically to support the MGAs and to act as a conduit between those MGAs and reinsurers, yourself. This growth, when it's first started, it was quite explosive, and you think, well, maybe this is a cyclical thing, maybe it's some story behind it. But now, is it right to describe this as something that is actually a secular change in the structure of the market and something new as a reinsurer? Is it something that you have helped drive, something you're happy with? When I talk to some of those people in the market, they'd say that perhaps one of the biggest drivers is reinsurers wanting to access some of that higher volume, low limit business, much less volatile and probably much more stable. And again, not necessarily very, very low combined ratio business, but sort of, tending around just somewhere below 100 type business, but business that, say, 30 years ago, you used to have a lot more of via all sorts of proportional relationships around the world. And these days, as your customers have got bigger and more sophisticated, they've been able to retain that business as they've globalized.
Mm-hmm.
Is that the right way of looking at it? Is that the correct thesis? So do you think it's a big permanent change in the market?
I think it's certainly a driver of the development of this market, access to risk pools, which could be attractive. It is, however, more of a North American phenomenon than a global phenomenon. So I wouldn't say, we have a real shift at a global scale. It's very much North American focus, some specialty classes. But clearly, there is a tradition as well. This is not a new field. There has always been an active and vibrant MGA community in the US. The thing is that you need to be very well equipped to monitor and manage that kind of relationship. You have a risk carrier on the one hand side and an underwriting agent who is not having skin in the game. And per se, it requires very stringent monitoring to make it work. It's fair to say that it has not always been a highly profitable value proposition for the reinsurance industry historically. So that will always be the caveat. The fact that that type of structure is increasing puts pressure on terms and conditions, on competition in the market, and can also be a way to precipitate soft market conditions. So we will not be among the players encouraging, accelerating this trend. Will look at interesting, well-managed entities and are open for business, but it's not the main approach for us to foster growth of the Hannover Re portfolio. I think we have a lot on our plate, a lot of opportunities in more traditional segments. This will be the prevailing way for us to grow.
And I suppose culturally, it sounds like this is something that's quite labor intensive from a reinsurer's perspective. You're going to do it properly.
Exactly. And we don't always have enough experts in our company to take care of this. Again, you need to be really well organized and adequately staffed to make it work, to make it profitable over time. So that's not our main focus in the current strategy.
But whilst it's not necessarily something that you think is a high priority for Hannover Re, do you think that it is actually a permanent change in the structure of the market?
I do believe at least in North America, that it's here to stay for sure. Yeah, there is a tradition, and it's certainly here to stay. I don't see a big change in that market structurally. So sooner or later we'll have to look at it again. But again, it depends also on the quality of underwriting. There are a big range of performance among the community of companies in that space.
Absolutely. You've always got to pick the winners in any case.
Exactly.
So Monte Carlo's coming around again. What's your message this time? Often you want to put out some kind of message before you arrive so that you can set people's expectations. What sort of expectations do you want to set in those meetings you're going to be having down there?
We are trying generally, to reflect a bit our views on where the market is. So we don't want to flood the market with big messages in the first place. We try to be as informative as possible when it comes to our media reach. But clearly for me, the key word, which I hope will be reflected in how your community receives Hannover Re's messages, is partnership. We're not transactional in the way we conduct our business. We're trying to create partnerships through the cycles, partnership for growth, partnership for innovation. And we'd like to clearly be that first call for our clients who run into difficulties, have volatile portfolios to manage, have new business opportunities, go into M&A, et cetera, et cetera. So if we can show that partnership card and be there for our clients to respond to their needs and requirements, that's already the message I'd like to convey. The rest is execution, as we say. And of course, there'll be topics which are relevant. I think climate change and NatCat will continue to be a big theme for the industry. We hope we won't have big hurricanes this season, but you never know. I think innovation will certainly be part of discussions. Cyber, after these awareness building events, I'll put it that way, will certainly be a topic. And then we'll see, it'll be more client by client. But we're open for business. We're in very, very good shape. Our balance sheet is strong. We continue to expand our share of wallet with the partners across the world. And we want to show a Hannover Re which wants to be relevant to its clients and work on narrowing down that protection gap I was talking about a few minutes ago. So it's all about relevance in partnering with our clients.
So it sounds like if you're still the first person that your clients want to call, then that's your job done, and that would be a successful Monte Carlo.
Absolutely, yeah. Being the first call is the KPI to judge if we're good partners. I always joke with the underwriting communities that if they have a badge of the companies they work with, that means they've done a good job. So they're working on having the badge, being able to enter the office and visit the clients. A bit of a joke, but it says something about creating a bonding and a strong personal relationship with our customers.
There's nothing wrong with being the market of last resort because you can charge whatever you like. But at the same time, it's nice to be asked first as well. You get a better showing.
We want to work with our customers, not against them. So first resort is the preferred position for Hannover Re.
More likely to get a diversified portfolio that way, aren't you?
Absolutely.
Excellent. Jean-Jacques, I've really, really enjoyed talking to you. Have a fantastic rest of the summer, and I'll see you down at Monte Carlo. I'm not sure if we've got a meeting in the diary. I think you're far too busy, but I'll probably see you in the lobbies and the corridors and soirees perhaps down there. And so I wish you all the best between now and then, and between now and our next meeting, which hopefully will be sometime this time next year. Let's hope. And good luck with everything.
Thank you very much, Mark. It was a pleasure to talk to you as always, and I look forward to seeing you in Monte Carlo.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance is produced in association with Advantage Go. Release your underwriters to underwrite with Advantage Go's underwriting platform. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.